Great to have you with us, Michael.
Thank you for having me, Michelle.
Today is a rainy day.
Yes, it's quite an awful day in New York.
Yeah, and it's also a Monday. You just said that Friday, today, this week will going to be like a wild day in this market, you mean, or personal life?
No, in markets, Friday was certainly a volatile day in markets where we saw very outsized moves, particularly in Turkey, but also in Iran. So given the imposition of U.S. sanctions on Iran and also some tariffs against Turkey, given what's happening there in the domestic political situation, we saw wild gyrations in currency markets as well as broadly emerging markets. So it was an unusual day, certainly, from that regard.
And from the chart, we noticed that U.S. dollar surged last week and the index rising 1.25%, most since April. So from your point of view, will the USD momentum be sustained?
Well, I think momentum is still quite strong in the U.S. economy, and that's part of the reason that the dollar is so buoyant. So the expectation that the economy will remain in an above-trend growth path because of fiscal stimulus is keeping expectations of Fed rate hikes in place. That's certainly helping to support the dollar. Some of the anti-trade rhetoric or protectionism that's coming out of the U.S. we also think is a factor. And then generalized weakness in emerging markets, some of which for fundamental, other for political reasons, that's providing support as well. So the dollar certainly has been strong for a variety of reasons.
And with the USD dollar at highs for the year, will the Trump administration lean against it?
I don't think so. I don't see that as being the case. Some of it is a byproduct of two of their policies. One, the protectionist agenda, but also fiscal stimulus. So this is what you would expect from the dollar in this world. It's risen enough where you would argue that it is a bit of a headwind, but the Fed's tightening rates, so you would think that tighter financial conditions, either through higher interest rates or a stronger dollar, is part of the natural outcome. So I don't think that it's something that's concerning at this point. The direction is in line with expectations, and I don't see the administration leaning against it.
And I believe one of the key questions facing investors right now is whether Turkey is a canary in coal mine, just like the way that Thailand faced right in the 1997, 1998,
Right.
the Asian financial crisis. So what's your point? Do you think it's a proverbial?
I don't. I think there were a lot of reasons why the emerging market crises in the 1990s propagated. So there were the fundamental issues related to the fixed exchange rate regimes, the opening of the capital accounts, which had created the conditions under which there were a lot of portfolio inflows. So when growth weakened and those exited, many emerging markets found that they had too many dollar liabilities, not enough foreign exchange reserves, and they were trying to defend the exchange rate system. We don't really have that now. Certainly the asset liability mix of emerging markets is different. Reserve positions are higher. There are many more floating exchange rates. So right now these are likely, at least Friday, were two isolated events in relation to sanctions being put on Iran and let's call them domestic political catalysts in Turkey. So I don't think it's systemic in the moment, but certainly it's something we're all paying attention to.
Yeah, the global market continued to feel the weight of the Turkish crisis, notwithstanding its central bank. The support is lira, but you think it probably won't get that worse, and we still need to see.
At least in terms of would it derail what the Fed is thinking? I would say right now, no. The Fed will look at emerging market weakness and think, well, is this feeding back into tighter conditions in domestic financial markets than we would want? I think the answer at the moment is no. Certainly Turkey is linked into Europe, and there are lines that you can draw that would suggest weakness in Turkey could create conditions under which the ECB would be more gradual. But expectations are that the ECB will be quite patient. So if it's, maybe broadly speaking, if it's EM volatility that's not associated with China, it's something that the developed world will largely ignore. We're obviously watching it and we'll pay attention to it. But if it's EM weakness that includes China, there's obviously some downside risk to growth in China, then that's a different story.
Yeah, the volatility of the Turkey and the emerging markets caused the Fed to slow interest rates. And then what do you think the path of the half year of the Fed raising interest rates?
Well, I think that certainly some of the EM weakness is related to Fed tightening because U.S. Treasury yields have moved higher and the dollar has appreciated. The U.S. Is, of course, the global safe haven. It's also the highest yielding developed market asset. So it is attracting some capital inflows because of that, which is coming at the expense of some emerging market stability. All that is to be expected in a Fed tightening cycle. So the question is, to what degree can the Fed keep doing that while it sees volatility in global financial markets? And again, they look at it through the prism of financial conditions. The dollar has strengthened. In a risk-off move, you would expect Treasury yields to maybe move lower or spreads to narrow, and maybe equity valuations weaken. So they would have to assess all three of those and say, did we get more tightening in domestic conditions than we wanted? Perhaps we should delay. But right now, I think the Fed looks at the domestic economy and sees plenty of momentum. I think at least for the rest of this year, the Fed will hike 2 more times, once in September and once in December.
Well, also to be sure, the recent strength in the U.S. dollar just caused like the cautious mood in the oil market. So do you think maybe this strong the U.S. dollar probably gonna put the unbearable burden on the oil market?
Certainly the dollar is one of the factors we consider in forming our view on oil, including demand and cost of supply, cost of production, I should say, as whether, in addition to other supply and inventory considerations. We think right now it's the supply and inventory consideration that's driving markets more. So we're much more concerned at the moment about outages in Venezuela and supply disruptions in Nigeria and Libya. We're worried about what sanctions could do about supply in Iran. So it's that potential supply inventory story that we think is the bigger factor right now. Our outlook is for oil to remain around $70 per barrel for the rest of this year and next year. But supply outages, we think, could perhaps drive that closer to 90. So certainly the dollar is a factor, but we think it's a second or third order factor at the moment.
What's your view on the second half of the year of the oil market about, you just mentioned the supply, and it's rebalancing the picture?
There is some rebalancing. So, I mean, Saudi Arabia and OPEC may be adjusting some of their supply to
They have the power in their hands?
Some. I mean, certainly it's more limited relative to before. The last 2 quarters, we've seen very solid structures investment in the U.S. That tends to be associated with the rig count and production of shale here in the domestic economy. So we do think that there are some supply offsets available to at least soak up some of those concerns. But once you start adding them all up, it may be unlikely that it can stop all of that or offset all of that. So for now, we think around 70 per barrel in the second half of the year is where things will stay, a bit of an offset. But there is a risk that more potent supply outages could push prices higher. We just don't see it as part of our baseline.
Okay, thank you so much for your comments today, and I believe that our viewers are gonna see you more on our show. Thank you.